The MILK project looks at client value in a number of different ways. And one of the ways that we assess value for clients of microinsurance is by looking at the value financially of these products vis-a-vis other products. We use a methodology that we call client math. We try to do the math for the client, understanding how the client's been using insurance and other non-insurance coping mechanisms to deal with their financial shock. Typically, we will visit clients of an institution that were insured as well as those who were uninsured to kind of benchmark what the different mechanisms are and make some sort of assessment of how the insured may have been acting differently from the uninsured as a result of their insurance. Well, it's difficult to us, for us to prove causality this way. It does give us a good sense of how people are using insurance, some of the improvements that can be made to insurance, and an opportunity to benchmark against other people who don't have the product as kind of a counterfactual. We also ask people what they would have done without insurance, but we're finding more and more that people really don't have a clear sense of what their alternatives are until they're in the crisis and having to deal with a financial shock. So we've been implementing client math in a number of different countries as well as across product types. So we're looking at life insurance, catastrophe or weather-related insurance, as well as health insurance. And we're finding that they're quite different from each other, and the country context and kind of social context do make a difference, and it's important to kind of quantify and understand those differences. When we go and visit these clients and do our client math, we're really looking for numbers. We're asking them the costs of the event and how those costs were financed in a very quantitative way. Even though our samples are quite small, it really gives us a good sense of how people are using their resources to cope with these shocks. One example that we'll see is in the Philippines, where we looked at life insurance and how people coped with that shock. The total cost of the wake, the funeral, and some of the other indirect costs related to the financial shock was about $1,665 on average for the insured group we spoke to. This was financed in a number of ways. Formal loans and loans from moneylenders and other informal sources took up a very small part of that, as did friends and family loans, which had a slightly larger role. The majority of the costs were really covered by gifts from friends and family. And this is the traditional way that people in the Philippines, particularly in rural communities, handle the financial costs of a wake and a funeral, which can be quite onerous. There were some smaller government subsidies and some diminished consumption, which is sort of the lack of food or cutting back on necessary expenses that we also see played a very small role. But what you can see from the chart is that even before the insurance benefit, most of the initial costs of the shock, including the wake and the funeral costs and related costs, were covered by these kind of traditional and community sources. So the insurance benefit played a different role. Rather than actually supporting the funeral and supporting some of the initial costs of the shock, where it really played a role is at a later date when the impact of having lost an income earner in the family hit the household. The insurance benefit actually helped to cover some of the forgotten income, repay some of those original loans, buy some new assets that could be income generating, or save a little bit so that they could support their household over time afterwards. Overall, we found it to be quite useful. In the Philippines, we looked at a calamity microinsurance product that covered flood, typhoon, and other kind of natural disaster-related risk. It was offered by Microinsurance to clients of TSKI and covered about $230 in claims benefits. The amount of money that was covered was actually a little bit low compared to what we found that insured clients really incurred in damages, both direct and indirect, which we costed out to about $436 on average. Another thing we noted as we did this study was that both insured and uninsured clients behaved quite similarly in terms of how they responded to the disaster, because the financial tools available to them were very similar, and the insurance didn't come for over a month, and so even the insured had to make do with their existing resources. That being said, we did find some differences. We found that the uninsured, for example, used savings and sold assets more than the insured, and this is a trend that we've seen across various client math studies now, where we find that respondents really prefer not to use their savings or not to liquidate assets, as this is quite inefficient. But the uninsured tend to be forced to do so because of a limited availability of different mechanisms to respond to these types of shocks. Income, we found, played a pretty small role, and this made sense given that after the floods, people really weren't able to get back to business and generate income the way that they were before the floods. What we did find, though, was the insured were slightly more likely to use informal loans from friends and family than the uninsured. And again, this is a trend that we've seen across our client math studies, where we're hypothesizing that insured respondents are using an expected payout on insurance, even when there's a delay in payment, as a type of collateral for accessing the relatively cheap and quick loans from friends and family. Whereas the uninsured perhaps don't dare because they're not sure that they're going to be able to pay them back as soon as the community will need it. Formal loans tend to be a very low response for the same reason. There seems to be an inability to pay loans back very quickly, and so neither the lenders nor the borrowers may want to get into that type of transaction. Where we do see support is in gifts, and the gifts here are both from community, friends, family, remittances, as well as local government and relief aid. But what we find is that despite sort of the well-intentioned and diverse sources of gift, they really don't make the cut in terms of covering the majority of the costs of the damages. And as a result, the insured and uninsured had to cut back on some basic consumption, including food and education and health expenses. The one difference, again, that we find is that the insured did eventually get their insurance benefit payment. Now, while this came later, it did have some advantages. It offered them the ability to repay their loans, both their formal and informal loans, as we mentioned, and to resume some of the consumption that was diminished initially. So it suggests that the insurance played a role in supporting these families and perhaps giving them a leg up vis-a-vis the uninsured in the same region.